Hello and welcome to this latest episode of the Driving at Profit with Zero Emissions podcast. I'm Barbara Albert, co-CEO of 100% Renewables, a consultancy specializing in the development of net zero strategies. Today's podcast episode is sponsored by AusIndustry, a Commonwealth government program. This recording is based on a webinar I recently ran under this program to explain the fundamentals of net zero to Australian small and medium-sized businesses. Now, AusIndustry delivers a range of programs to support Australian small to medium businesses to boost profits, create more jobs, become stronger and more resilient. Their programs help eligible businesses strengthen, grow and innovate, and develop and commercialise new ideas and products, locally, nationally and globally. The program connects businesses with support available from across all levels of government, from the Australian government through to the local level. The AusIndustry network of business development managers, regional managers and facilitators are spread across Australia, and they provide you with targeted support and guidance to help your business grow, diversify and thrive. Please also note that the Entrepreneurs Program is collecting expressions of interest to be part of a net zero supply chain project launching in Perth and Brisbane in July 2022. Involvement in this project is free and provides eligible businesses with access to industry networks, expert resources, and to promote your net zero business goal. Please email me if you would like more information. We're currently helping one of our clients go through a net zero pathway under this program, or you can also Google the Entrepreneurs Grant Program. Because there's so much content that I'm going to cover, I've recorded 2 episodes, and you're now listening to the first part. Now is the time for everyone to exemplify good environmental stewardship, including businesses, not only to help limit climate change, but to future-proof them for the net zero economy that is coming. Large public companies now face pressure to eliminate carbon emissions from their supply chains, their operations and products and services, or for capital providers from their financed emissions. And this pressure will intensify and spread to smaller public companies and to private companies. There will be no place to hide. And if your company doesn't have a plan for competing and winning in a net zero economy, it's time to make one. And I was engaged by AusIndustry to speak on exactly this topic. So we've got a lot to cover. In the first episode, I'd like to give an introduction to the carbon jargon. Net zero hasn't been around for long, and there are many terms that people need to wrap their head around, such as the 3 scopes and emission sources. In this first episode, I'll also talk about how you can calculate your carbon footprint and what your emission reduction opportunities might be. I'll also show you how you can construct a pathway to net zero and to carbon neutrality. And then in the next episode, I'll talk about offsetting and insetting. I've got 2 whole sections devoted to carbon offsetting, carbon farming, and the new concept of insetting. So I hope you're looking forward to hearing more about that in the next episode. So today I'd like to start my presentation on net zero, telling you the story of the rise and fall of Kodak. Kodak was founded in the late 1880s and became a giant in the photography industry in the 1970s. Its share price rose to a high of over $90. 15 years later, it filed for bankruptcy in 2012. Kodak was making a lot of money selling cameras and film rolls, but in the 1990s, the photography industry began to shift towards digital. The sale of film rolls declined while the sale of digital cameras increased. And if that wasn't enough, a second turning point happened with the rapid rise of smartphones. We all know how quickly we adopted this new technology. People went from printing pictures to storing them on digital devices or sharing them online on social media platforms. In the face of these turning points, Kodak resisted the change and failed to reinvent itself. No one at the top tried to address the problem or even recognize the urgency of the problem. Kodak also avoided risky decisions and instead maintained the status quo. Now, this is a turning point in our climate. We enjoyed a safe climate for thousands of years until we discovered fossil fuels and started to burn them from the 1850s. We've now got dangerous levels of carbon dioxide in our atmosphere, which has already resulted in warming of more than 1 degree Celsius globally, the effects of which are visible in our droughts, our wets, and extreme weather events. In 2015, the landmark Paris Agreement was reached. The adoption of this agreement set a clear signal that we must reach net zero emissions by 2050 to avoid catastrophic climate change. Now, how does the Paris Agreement affect companies? Well, firstly, governments of countries that have signed up to the Paris Agreement are now putting additional focus on climate action. This can result in big emitters having to reduce their emissions or pay for their emissions, or in additional support available through the government, such as the Entrepreneurs Program, who's sponsoring today's podcast episode. Then there is investor pressure. You may have heard of the TCFD, the Task Force on Financial Disclosures, which was created in 2015 to develop consistent climate-related financial risk disclosures for use by companies, banks, and investors in providing information to stakeholders. And now there is a lot of action by corporates. You may have noticed a huge increase in commitments to net zero and climate action by many of the large companies, but also increasingly by smaller and medium-sized organizations. And then consumer sentiment has changed, and customers are starting to abandon carbon-intensive products. For instance, people and organizations are starting to divest from fossil fuels, and some people are shifting their diets and are becoming vegetarians. There are also international trade implications. The EU, for instance, has a carbon price, and they have released a carbon border adjustment mechanism, which will make it more expensive to export goods to Europe. It makes no sense for governments to make domestic businesses pay for the right to emit while allowing overseas competitors such as Australian businesses to emit for free. Now, given how the landscape is changing and these external pressures, how will you manage climate risks and opportunities? Well, the first step in managing something is to measure it, to take the status quo. I suggest having a look at your carbon footprint in the first instance to know where your emissions are coming from and how big they are. But before I can talk about how you can calculate your carbon footprint, I need to explain a few terms first. Unlike financial accounting, in carbon accounting we have scopes. There are 3 scopes which are called Scope 1, Scope 2 and Scope 3. Scope 1 emissions are emissions you directly generate, usually by burning fossil fuels by something that is owned or controlled by you. An example is driving a petrol-based company car. Scope 2 emissions are indirect emissions. It's your electricity consumption. Electricity consumption is such an important emission source that it has its own scope. Now, when you plug in your laptop, for instance, emissions don't come out of the power plug, but they do happen upstream where electricity is being generated. Unfortunately, in Australia, the majority of our electricity generation comes from fossil fuel power plants. Now, if it's not a Scope 1 or a Scope 2 emission source, it's got to be a Scope 3 emission source. Scope 3 emissions happen upstream and downstream from your organization. It's basically goods and services you buy and goods and services you sell. I'll now show you a couple of examples of emission sources and I'll give you the scope. Here is an example of a Scope 1 emission source. A boiler that takes natural gas as a fuel directly generates carbon dioxide emissions when the gas is being burnt. Refrigerants in air conditioning and refrigeration equipment is another source of really potent greenhouse gas emissions. Now, air conditioning equipment is not hermetically sealed and these gases escape into the atmosphere. And if you have ever had your air conditioning equipment regassed, you'll know what I mean. Refrigerant leakage happens directly from equipment you own or control, so it's a Scope 1 emission source. Here is another example of a Scope 1 emission source. If you own or control a truck fleet, this will contribute to your Scope 1 emissions. And here's an example from the agricultural sector. Cows belch a lot of methane, which is a powerful greenhouse gas. If you own cows or sheep or goats, this would be a large source of Scope 1 emissions. And also land management practices is another example of Scope 1 emission sources. For instance, applying fertilizer, land clearing, and manure from piggeries are examples. And now to Scope 2, which in a lot of cases is a big source of emissions. Everything that consumes electricity by equipment that you own or control falls under Scope 2 emissions. An example of Scope 3 would be purchased goods and services. It's called the Category 1 and also Category 2 under the Scope 3 emission sources. Pretty much everything we buy comes with embodied emissions or upfront carbon. This is because someone else would have produced that good or service with the help of fossil fuels, such as electricity consumption or by burning gas, petrol or diesel through transportation or through stationary purposes such as natural gas burning. Now, interestingly, not all the electricity that is being produced in centralized power plants will make its way to you. Did you know that the grid consumes some of that electricity? Say a power plant produces 110 kilowatt hours, but what you get out of the power plug will only be 100 kilowatt hours. The other 10 kilowatt hours get lost during transmission and distribution. It's good carbon accounting practice to account for these losses. It's a Scope 3 emission source. Travel is another example of a Scope 3 emission source if you don't own the plane. If you're lucky and you do, it's your Scope 1 emission source. And unfortunately, we all produce waste. And when this waste ends up in landfill, it produces methane emissions, which again is a powerful greenhouse gas. Now, staff commute is an example of a Scope 3 emission source you wouldn't readily think of. But when employees commute to their office, this causes emissions, especially if they're using their cars to do so. Sometimes they probably don't have a choice, especially in regional areas where there is little transport, where distances are big. But yeah, if they use their cars, it's a big source of emissions. And then if you're engaging someone else to transport your goods or to transport goods to your place of work, then this is also a Scope 3 emission source. It can be quite large if your line of work involves a lot of transport. And here is an example of downstream Scope 3 emission source. Imagine you're selling laptops or washing machines. The electricity consumption that these machines have when they are being used are part of your value chain emissions. So these are all examples of Scope 1, Scope 2, and Scope 3 emission sources. Now, Scope 1 and Scope 2 emissions are fairly easy to calculate. So let's have a more detailed look at Scope 3 emission sources. If we just look at your innermost carbon footprint, it will consist of your Scope 1 and Scope 2 emission sources. For instance, driving company cars, burning fossil fuels such as gas or coal, and refrigerant leakage in air conditioning equipment. Scope 2 is your electricity use. However, your company, of course, doesn't exist in isolation, or hopefully it doesn't. You have other companies from which you buy things, and there are also other upstream activities which cause emissions. For instance, most of your OPEX and your CAPEX have an associated carbon footprint. There's also upstream energy, which is the transmission and distribution losses in the grid I mentioned earlier, and the production of fossil fuels such as diesel, and getting the fossil fuel to you. Now, transportation and distribution are emissions associated with buying the services of a freight company. And then there is waste, business travel, staff commute, and emissions from assets you lease. So for instance, if you lease an office and the landlord pays for the electricity, it would form part of your upstream electricity consumption, which would be a scope 3. There are also downstream activities associated with your value chain. For instance, transportation and distribution of goods that you sell, further processing of your products in another company. So say your product forms part of the input of another factory. Now, the use of your sold products, for instance, the electricity consumption if you sell washing machines, which I mentioned earlier. There's also the post-consumer waste, or the waste of the products you sell once they have reached their end of life. There are potentially facilities that you lease to others. So if you are leasing your buildings to others, it would be a downstream emission source. It might be franchises you might have, or even your investments. So it's particularly important, an important emission source for financial institutions, for instance. So here's the full value chain. Your organization in the middle, you have upstream and downstream activities to the side. And of course, the reverse is true as well. If you produce a good or service and you sell to another organization, then you are part of the upstream activities of that particular company. And the lower your carbon footprint, the better for the carbon footprint of the purchaser of your goods or your services. Even better if your products or your services were carbon neutral, as they would then form a carbon neutral input into other companies. So bear in mind that your scope 1 and scope 2 emissions are someone else's scope 3 emissions, which means that you're all accountable for it. You may have already experienced your customers asking you for your carbon footprint. It may not be too long before the pressure is on to become a carbon neutral or a net zero supplier. Now that we know where emissions are coming from and what the 3 scopes are, let's have a look at how you can calculate your carbon footprint. There are 3 steps to calculate your carbon footprint. Firstly, you need to identify the boundary of what forms part of your carbon footprint. Every company and every situation is unique, so you need to identify emission sources that are relevant for you. Once you know what emission sources are part of your carbon footprint, you need to collect what we call activity data. Activity data are things like your electricity consumption in kilowatt hours or your natural gas consumption in gigajoules or megajoules. Once you have the activity data, it's relatively straightforward to calculate your carbon footprint. Let's have a look at these steps in greater detail. Step number 1. Which emission sources should you include in your carbon footprint? And here I'm going to show you my famous onion graphic. Most businesses are aware of their scope 1 carbon footprint, which is emissions that come from burning natural gas or the fuel in company cars. And most businesses will be aware of the scope 2 emissions, which is the use of electricity. However, there is usually a lack of awareness of scope 3 emissions, which happen both upstream and downstream of your business. Examples of your value chain emissions are paper, IT equipment and water consumption, waste or air travel. When you look into your value chain emissions, it's actually really hard to stop. There are so many emission sources that you could potentially include in your carbon footprint. But of course, your resources aren't endless, so you have to draw the line somewhere. This line will determine the boundary which you will use to calculate your carbon footprint. And it could also be the starting line of your net zero journey. Step 2 is collecting activity data. Activity data is the underlying activity that causes emissions, and here we're looking for the right data that will help us to calculate the carbon footprint. Sometimes data can be based on the consumption of fossil fuels in liters or megajoules, or on how much we spend in a particular cost category, or how much waste goes to landfill. Now, where can you get activity data from? There are a couple of things that come to mind. You can get data from your carbon management software, which are tools such as Invisi, Azility, E21, Trellis, and similar platforms. If you have such a software in place, you are in a very good position because this software almost automatically generates the carbon footprint for you. You connect it to your systems and it extracts electricity consumption from bills or tracks Scope 1 emissions, then does the reporting for you. It's good to have that, but it comes with a price, so not everyone can afford that. You may also be able to get data from your electricity bill or your retailer. Some of our clients are provided with an online portal by the retailer where they can jump in and extract the electricity information. If you use fuel cards in your business, it makes it easy to extract your fuel use because a fuel card enables you to get a report at the end of every period and you can see exactly how many liters of fuel you consumed. For some of the Scope 3 emissions, it's great to get data from your general ledger. You can get an extract of all your expenditure from your finance system and then use that information to translate from expenditure into emissions. This happens a lot with category 1 of Scope 3 emissions, which are purchased goods and services. So everything that you purchase in your organization finds its way into the general ledger and is stored under specific codes. You can look at your category of expenses, such as, for instance, IT equipment or paper consumption or stationery, and estimate emissions that are caused by this spending activity. You can also get data from other data collection systems, such as from HR. For instance, if you want to look at emissions caused by staff commute or at emissions caused by employees working from home, it's really helpful to get the number of FTE from your HR team. They can also help with letting you know how the pandemic changed work from home behavior and when people were not traveling to the office. The HR department may have also conducted an employee survey, which you can use and then extrapolate from a small data set to perhaps the whole organization to get a better picture of your employee commute emissions. You can also get data by interviewing and surveying staff. If you have a travel agent who provides you with a report on who has traveled where, which is important from an emissions perspective, that's great. But if you are a small company, you might just survey your staff, like, how many times did you travel last year? Where did you go? Etc. You might also survey your suppliers, for instance, contractor vehicles, to ask how many liters of fuel they burned while working for you. So the question always arises whether you need perfect data for everything. And luckily you don't. There is a thing called the data collection hierarchy. The best data you can have is actual data, which could be known resource consumption over a set period of time, such as, for instance, data from your fuel cards. If you don't have actual data, you can take modeled data. For instance, when you start collecting your electricity data and you get billed quarterly, you found only 2 electricity bills in your folder and 2 are missing and you can't find the bills. Well, you take what you have and maybe you can extrapolate that information to a whole year. You're starting somewhere, you've got something, it's acceptable to do that. It doesn't have to be a perfect system when you start out. Another example is when you want to know how many tons of waste you produce, but sometimes you only have the volume of the waste. How do you get to the tons of waste? Well, you can apply conversions and assumptions. And sometimes you also need to extrapolate data, such as taking the results from a staff or vendor survey and extrapolate that to a full yearly data set. Also, where data is expensive or difficult to collect, you could collect actual data once every few years and in subsequent years adjust for inflation, staff numbers, or other relevant factors to estimate the current year's data. Now, where you don't have actual data or where you can't model data, you can also estimate it by using online calculators or general statistics. Where specific data is unavailable, an estimate may be made using statistics or other relevant industry standard statistics. Climate Active, which is a fantastic program here in Australia, provides such calculators for employee commute, taxi travel, or work from home emissions, for example. Now, if all of this fails, you can also apply what we call an uplift factor, where it's impossible to get data for an emission source, which is part of your carbon footprint. You can make a best guess to increase the size of your carbon inventory to allow for the inclusion of a specific emission source. For instance, it may be difficult to get data on your air conditioning equipment. It's acceptable to increase your carbon footprint by applying an uplift factor to account for emissions caused by refrigerant leakage. We've talked about step 1, drawing the boundary around your carbon footprint, then step 2, collecting activity data, which is the most time-consuming step because initially you don't know what you're looking for and it can be a bit complicated, so it takes a while. Step 3 is once you have the data, you can calculate the carbon footprint, which is much easier than step 2. Typically, this is what happens. As carbon accountants, we take the activity data, we apply an emissions factor that's appropriate, and we get the resulting carbon emissions. Now, where can you find those emissions factors? The best source for all Scope 1, Scope 2, and for some Scope 3 emissions can be found in the National Greenhouse Accounts factors. You can Google National Greenhouse Accounts and you can find the most up-to-date factors for Australia. If you're looking to get certified under Climate Active, they have calculators that contain hundreds of emission sources and you can just put in your activity data and the spreadsheet spits out the carbon footprint at the other end. It's very handy, but the only way you can get access to those calculators is if you are seeking to get actual certification under the scheme. The third option is to engage consultants such as my firm 100% Renewables. There's lots of consultants that can help you with calculating the carbon footprint for you. It's a great option if you can afford it because it can get quite tricky as there are lots of rules involved. So a recommendation is to potentially engage consultants because it can get quite tricky, especially initially when you set up your systems. Now, here's an example of an extensive carbon footprint we developed for one of our clients. This particular client has Scope 1 emissions such as natural gas, emissions from fleet and refrigerants. For this particular client, Scope 2 or electricity emissions are by far the biggest emission source. This is typically the case for most businesses. We've also calculated emissions from the value chain. For this particular organization, purchased food and catering is the second highest emission source, followed by purchased professional services, such as, for instance, consultants. Now that we have calculated the carbon footprint, let's have a look at how you can reduce this carbon footprint to net zero over time. There are many ways businesses and individuals can reduce the carbon footprint. Our approach to helping organizations develop their plans and roadmaps for renewable energy and net zero carbon emissions reduction is based on an avoid, reduce, produce, purchase model across a business's operations, fleet, and their supply chain. That is, avoid emissions through resource waste reduction in design, operations, and supply chain, reduce energy demand and emissions through efficiency, electrification, and technology change, produce your own energy through solar PV and battery storage, and for the balance of energy and emissions, to source this over the long term via offset and renewable energy purchases, and to reduce emissions even further through sustainable purchasing. For companies that are large landholders, you have additional options such as storing carbon in vegetation and soil. I mentioned electrification earlier. This is where you change from burning a fossil fuel such as natural gas to using electricity. So for instance, changing from a boiler that uses natural gas to changing that to a heat pump. You know that I'm the host of the Driving the Profit with Zero Emissions podcast because otherwise you wouldn't listen to it. Now, if you listen to episode 9, this is the episode in which I interview Saul Griffith on electrifying everything. It's really worthwhile to listen to this episode if you want to find out more about electrification. Now, hybrid and electric vehicles are another form of electrification. Even if an electric vehicle is charged from the grid, emissions are so much less compared to internal combustion engines. Even better if you can charge your electric vehicle from solar. And the more efficient your air conditioning is, the less you have to pay to run it, the fewer emissions you will have. The same applies to lighting. The standard nowadays is LED lighting. So if you don't currently use LEDs, you should definitely investigate making the switch. Solar panels is almost a no-brainer, and we can see how popular these are. 30% of Australian dwellings have solar on them. Australian rooftop solar is the cheapest energy in the world. So if you haven't yet installed solar, you should definitely look into that. Battery storage is a fantastic add-on to solar, and we're seeing prices come down. Buying renewable energy can make a big decrease in your carbon footprint, as energy consumption, as I've said before, can be one of the biggest emission sources for a company. Sustainable design will help to save a lot of dollars in running your facilities. And reducing paper consumption is good for the environment and good for your expenses and your storage needs as well. You can also purchase products that are carbon neutral, as you don't have to count the purchase of these products towards your organizational carbon footprint because it comes in as a carbon neutral input. And here's another example of a carbon neutral input. You can also purchase carbon neutral bricks when you construct buildings. Not sending waste to landfill saves methane emissions in the landfill. And you should always tick the Make My Flight Carbon Neutral option, as your extra dollars will help to fund projects that avoid or sequester emissions and may come with additional co-benefits. Trees are magnificent because they absorb carbon emissions when they grow. In episode 10 of my podcast, I interview Rob from Flint Pro on carbon removals in the land sector, another episode that is worth listening to. If you grow cattle, herd management may be another way to reduce emissions associated with beef production. And soil carbon works by increasing the carbon content in soil and is one of the acceptable methods under Australia's Emissions Reduction Fund. Purchasing carbon offsets should be your last resort. After you have reduced emissions as much as possible, you can purchase carbon offsets to reach net zero or carbon neutrality. So let's have a look at net zero. What does it actually mean? I just love the definition that Swiss Re has provided, which is do our best and remove the rest. Do our best means focus on deep decarbonisation of your business. Do as much as you can to bring down your own emissions. But then once you've arrived at the point where you can't do anything else, you focus on carbon offsets or insets to remove the rest of the emissions and bring it to net zero. Here are the steps you can apply to achieve net zero emissions. You draw the boundary around your carbon footprint, you set a target year, which could be now, or it could be sometime in the future. Then you calculate your carbon footprint. You include your scope 1, scope 2 and scope 3 emissions, and then the journey starts. How can you avoid carbon emissions? How can you reduce carbon emissions? How can you produce renewable energy? And for the remainder of your carbon footprint, you can purchase renewables, carbon neutral products, sequester carbon in land or vegetation, or purchase carbon offsets. At that point, you land at net zero and can then declare carbon neutrality. This is a net zero pathway we developed for one of our clients that is based on the footprint I showed you earlier. In the absence of any carbon reduction activities, emissions will grow. However, because the grid is getting greener, your electricity-related emissions will fall automatically over time. You will rarely achieve net zero emissions with a single silver bullet solution. There are many opportunities that contribute to a net zero goal, such as energy efficiency, on-site solar and batteries, renewable energy purchasing, waste management, fleet electrification, and supply chain initiatives. Now, grid decarbonisation happens slowly. You can't wait for grid decarbonisation to take care of your electricity emissions. Businesses and individuals need to act now themselves with actions like efficiency, solar and buying renewables that reduce emissions and save money. Over the next 1 or 2 decades, depending on what makes up your value chain or your scope 3 emissions, you can work with customers, your suppliers and other stakeholders to drive these down while creating new opportunities for your business to prosper over the long term. In the long term, you should minimize carbon offset purchases and use them only for those emissions that are too hard to reduce or remove directly. However, buying carbon offsets now may still be a great strategy, as it can show leadership and set an internal price on carbon. But over time, the goal should be to reduce your carbon offset purchases to zero while reaching net zero emissions. In this pathway, you can go carbon neutral right away, which means you need to purchase carbon offsets to the full amount of your carbon footprint. However, carbon offset purchases reduce over time. Decreasing emissions means that you spend less money on purchasing carbon offsets. You can use the money you save by investing further in emissions reduction opportunities. These are examples of brands that have chosen to go carbon neutral right away. So you can see here Biopack, Bank Australia, Canva, Texas, Westpac, Telstra, Xero. This wraps up part 1 of my special podcast recording on the fundamentals of net zero for Australian small and medium-sized businesses. You now know how you generate emissions, what scopes are, how to calculate your carbon footprint, what emissions reduction opportunities you have, and how to construct net zero or carbon neutral pathways. If there are any areas that you would like to find out more about, please head to our webpage www.100percentrenewables.com, where you can find links to many more resources that can help you on your net zero journey. Please also watch out for part 2 of this recording, which will be released soon. In part 2 of this special recording, I'll talk about carbon offsetting, carbon farming, and insetting, a whole new concept you may wish to find out more about. And as always, if you know another person who you think will enjoy this podcast, please let them know so that more people can hear about best practice stories of how organizations are moving to net zero emissions. Thanks for tuning in, and I hope to see you in part 2 of this special recording.